Welcome back to the deep dive. Today we're going deep, really deep, into a book that's basically legendary in the investing world, right? The Intelligent Investor.
Oh, yeah, Benjamin Graham's Intelligent Investor. It's practically the Bible of value investing.
It is. It's been around for decades and people still swear by it. So
Literally.
we're going to see if it still holds up.
Yeah. See how it applies today.
How can you actually use it to build your own wealth? Not just like theory, but practical stuff.
Totally.
So Ryder McGraham kind of throws down this challenge. Are you an investor or a speculator? What do you think he means by that?
He's really separating those two. In investing, for Graham, it's all about really digging deep, research, understanding the actual value of a company.
Right.
Speculation, on the other hand, it's all about trying to, time the market, make those quick bets.
So short-term thinking.
Totally short term, hoping for those quick price swings.
Gotcha.
It's almost like he says it's the difference between planting a tree and just predicting the wind. You know?
Ah, I like that. One is about nurturing something long-term,
Exactly.
and the other is just kind of like, hoping for the best.
Yeah, hoping for the best, but it's really tough to predict that wind.
Absolutely. So he makes it clear you can't build, lasting wealth by chasing fads or, getting those hot stock tips.
No, you got to think long term, like you said, cultivate.
It's about that steady growth.
Yeah.
Okay, but here's the thing that worries me, especially these days.
Okay.
Inflation.
Yeah.
How do you protect your money when, everything's getting more expensive?
Inflation, that's a big one. One of the best weapons against inflation is diversification. Think about building a financial fortress that can withstand, any economic storm.
Oh, okay. So like multiple layers of protection.
Exactly. So, you got your stocks, you got your bonds, you got real estate.
Oh, I see. So if one's doing bad,
Yeah, each reacts differently to inflation.
the other can kind of hold it up.
Exactly. If one takes a hit, the others are there to help.
Okay. So it's like not putting all your eggs in one basket.
Exactly, spreading that risk. And, Graham really highlights those real assets, like real estate or commodities, because they tend to benefit from inflation. Their value goes up with it.
Right, because you're actually holding something tangible.
Exactly. You're holding something tangible, and as prices rise, those assets become more valuable.
But okay, even with those, you can't just jump in blindly, right? You still need to do your research.
Oh, absolutely. Thorough analysis is key for any investment.
Yeah.
And, speaking of analysis, that kind of leads perfectly into Graham's deep dive into the stock market history, like a whole century of booms and busts.
Oh, wow. He goes way back.
Oh, yeah, it's like going through the Markets Family album, all those ups and downs.
Makes you wonder if those market swings are just, as predictable as the seasons changing.
That's a good question.
Yeah.
Graham, he says those cycles are inevitable. What goes up must come down,
Right.
and vice versa.
Yeah.
But the key is, don't get spooked by those short-term things, right?
Ah, easier said than done, though.
It is easier said than done, but the market has always recovered. And those who keep their eyes on the long game, they're the ones that get rewarded.
So it's like you're watching a dramatic movie. You know there's going to be those twists and turns, but it's the ending that really matters.
Exactly. Focus on the big picture. And that kind of brings us to this idea of, he talks about the defensive investor.
The defensive investor, so this sounds like someone who's like hiding their money under a mattress.
Not at all. No, they're not hiding. They're definitely in the game. They want to protect their capital, earn a reasonable return, but they don't want to be glued to the market ticker every second of every day.
Gotcha. So a little more like balanced, low maintenance.
Exactly. Balanced and low maintenance. They're looking for steady growth, not those heart-stopping roller coaster rides.
Okay, so what's their secret weapon? How do they play this game?
Asset allocation, that's their secret weapon. Graham recommends a mix of high-grade bonds and quality stocks.
I see. So bonds for that stability, stocks for potential growth.
Exactly, you got it. Bonds provide that stability, that income, and stocks offer that potential for growth over time. You're finding that sweet spot, balancing risk and reward.
So it's kind of like a financial safety net, right?
Yeah, financial safety net. And don't forget diversification.
Oh, right. We talked about that with inflation.
Spreading your investments across different sectors and asset types, it's like having multiple layers of defense.
So you're prepared for whatever the market throws at you.
Exactly. You're ready for anything.
So for the defensive investor, do they need to be constantly tweaking their portfolio?
No, they're not glued to their screens.
Right.
Regular reviews, maybe once a year, make sure things are on track.
Okay, so they're staying calm amidst the chaos.
Exactly. They're not letting those daily ups and downs distract them from their long-term goals.
That sounds pretty appealing, actually, for those of us who aren't financial wizards.
Absolutely. It's about building wealth steadily without the stress of trying to outsmart the market every single day.
Okay, but what about stocks specifically for the defensive investor? Because stocks can seem, pretty risky.
They can feel like a roller coaster, but Graham emphasizes quality over quantity.
Okay.
Focus on well-established companies, proven track record of paying dividends. It's like choosing friends, You want the reliable ones.
The ones that have shown they can weather the storms and still be there for you.
Exactly. Exactly. Those companies that have stood the test of time and consistently reward their shareholders.
Okay, makes sense.
And while stocks do offer that growth potential, Graham still advises, even for the defensive investor, keeping a conservative allocation.
Gotcha. So find that comfort zone where you can actually sleep at night.
Exactly. Sleep well at night. And now hold on tight because we're shifting gears and we're going to meet the enterprising investor.
The enterprising investor, this sounds a little more exciting, maybe a little riskier.
It is a little more adventurous, definitely. They're willing to put in more effort, more time, more research for the potential of bigger rewards. But Graham is super clear about the need for diligence here.
Okay, so it's not just about, throwing darts at a stock board.
No. It's informed decisions.
It's like being a strategic chess player, thinking multiple moves ahead.
Exactly. And they might do deep analysis, try to find those undervalued companies the market has missed.
So it's like being a detective, searching for those hidden gems.
Exactly. A treasure hunt, if you will. And because of that, they might need to be a little more hands-on with their portfolio, actively managing, adjusting as needed.
Okay, so a bit more dynamic.
Much more dynamic.
Yeah.
But Graham warns about some traps.
Traps? Okay, we got to know about these. What are the traps for the enterprising investor?
First and foremost, beware of hot stock tips. By the time everyone's buzzing, the profit potential, it might be gone.
Oh, yeah, it's all hype, no substance.
Exactly. Hype, not substance. And be cautious of new stock offerings, tempting, but often they're priced with more optimism than evidence.
Okay, so do your homework before you jump in.
Always do your homework.
Yeah.
And speaking of homework, watch out for those fees.
Oh, yeah, fees can really eat into your returns.
Absolutely. They can really take a bite out of your gains. Graham stresses minimize costs.
Be a savvy shopper.
Savvy shopper, that's it. The enterprising investor needs to be sharp, analytical, definitely do their research.
Got it. So tell me a little more about how they go about finding those undervalued gems.
It all starts with that thorough analysis. They're diving deep into financial statements.
Yeah.
Understanding a company's fundamentals, really looking for those diamonds in the rough.
So not just glancing at a stock price, but actually understanding the business behind it.
Exactly. Understanding the business. And remember those special situations we talked about earlier.
Right.
Mergers, acquisitions, spin-offs. Those can be unique opportunities for the enterprising investor. But again, requires careful research. Timing is everything.
Oh, that's right.
You have to be strategic.
So unlike the defensive investor, they need to be ready to act kind of on the fly.
Much more active, much more engaged.
Okay, now, I think we need to talk about one of the biggest challenges in investing, and that is market fluctuations.
Oh, market fluctuations. That can make anyone sweat.
Those ups and downs, they can really mess with your emotions.
It's a roller coaster that sends your emotions on a loop-the-loop.
So how do we stay sane when the market's freaking out?
Well, Graham has a great metaphor for this. He talks about Mr. Market.
Mr. Market, okay. Who is this Mr. Market, and should we be taking his advice?
Picture this. Mr. Market shows up at your door every day, wanting to buy or sell stocks at all these different prices. Some days he's super excited, prices are high. Other days he's doom and gloom.
Okay, so kind of unpredictable.
Totally unpredictable, his mood swings all over the place.
So should we listen to him?
The key is he's driven by emotions, not logic.
Ah, okay.
His prices might reflect those temporary feelings, not the real underlying value of those companies.
So don't let his bad mood ruin your day.
Exactly. Don't let his mood dictate your actions.
So it's like having this unpredictable business partner. You got to listen, but ultimately make your own decisions.
Exactly. You're the one in control. And that takes us to the heart of Graham's investment philosophy, focusing on intrinsic value.
Okay, intrinsic value. Is this just a fancy way of saying what a stock's really worth?
It's more than that. It's the true worth of a company based on its assets, its earnings, dividends, future potential.
So it's like looking beyond the surface at the actual substance of the business.
Exactly. It's a more stable measure than that fluctuating market price that Mr. Market throws around.
So how do we figure out this magic intrinsic value? Is there a secret formula?
No secret formula, but it takes investigation looking at everything that contributes to a company's worth.
So this is where the digging deep into those financial statements comes in.
Exactly. Analyzing those earnings reports, truly understanding the company's business.
So it's like being a detective, uncovering the real story behind those numbers.
Exactly. You're a financial detective. And once you have a grasp of that intrinsic value, you can make smarter decisions.
So buy low, sell high, essentially.
In a way, yes. Buy when Mr. Market is undervaluing, sell when he's overly optimistic.
So you're always looking for those bargains.
Always looking for those bargains, being a smart shopper.
Makes sense. Now, I think a lot of people, when they think about investing, they think, okay, I need a strategy. What does a good investment strategy look like?
It's not just picking stocks. It's having a set of rules that guide your decisions.
Okay, like a set of principles you stick to.
Exactly. Think of it as your investment constitution. Keeps you grounded, helps you avoid those impulsive moves.
So taking emotion out of the equation, having that systematic approach.
Exactly. Systematic and rational. And that brings us to one of the most important qualities for any investor, and that's discipline.
Discipline. That's easier said than done, though, right? Especially when the market's going crazy.
Tell me about it,
Yeah.
especially when everyone's either panicking or getting greedy.
Right, you got to block out all that noise.
You got to block out the noise, stick to your principles.
Not react impulsively.
Exactly. Avoid those emotional roller coasters. That's what sets apart the intelligent investor.
So it's like being a captain navigating a storm. You need a steady hand, a clear course.
You got it. Steady hand, clear course.
Now, I think we need to demystify another part of the investing world, and that is investment funds.
Ah, investment funds. They can be a bit of a black box for a lot of folks.
They are. What are they all about?
So basically, they pool money from multiple investors
Okay.
to buy a diversified portfolio of stocks or bonds.
So you're kind of like joining a club?
Yeah, think of it as joining a club where everyone chips in to own a piece of the market.
So it's a way to diversify without picking individual stocks yourself.
Exactly. You're letting the experts do some of the heavy lifting.
Okay, but are there different types of funds?
There are. You have actively managed funds and passively managed funds.
Okay, what's the difference?
Actively managed, you have a manager making decisions, trying to beat the market.
Okay.
Passively managed, just track a market index.
So actively managed, it's like having a personal shopper.
That's a great analogy, a personal shopper for your investments.
And then passively managed is more like buying that pre-made basket of goods.
You got it pre-made, set it and forget it kind of thing.
Okay, so which is better?
That's the million-dollar question, isn't it?
Well,
Actively managed, they sound more appealing, right?
right? Because you have someone working for you.
But they come with higher fees and don't always outperform.
Yeah.
Passively managed, lower fees. They just try to match the market.
So, Graham, what does he suggest?
He says, do your homework.
Always do your homework.
Before you invest in any fund, look at the track record, look at their strategy. Most importantly, does it align with your goals, your risk tolerance?
Okay, so it's about finding the right fit for you.
Exactly.
Now, what about this? A lot of people, they struggle with, do I need a financial advisor?
That's a good question. Finding the right financial advisor can be like finding a needle in a haystack.
It can be tough.
But the right one, Graham says, can make a world of difference.
Because they have the expertise.
They got the expertise, they offer guidance, they can help you navigate those complexities.
Right, but how do you know who to trust? There's so many out there, all claiming to have the secret formula.
It's overwhelming. Graham gives some advice here. Look for a solid track record, a philosophy that matches your own,
Okay.
and, most importantly, integrity. It's like choosing a doctor. You want someone with your best interest at heart.
So you need transparency, you need to know how the game's played.
Absolutely. No hidden agendas. And here's another point. No matter how much you trust your advisor, you should always be in control of those decisions.
Right, so they're a guide, not a dictator.
Exactly. You're the captain of your financial ship.
I like that. Now, here's another thing. When people hear security analysis, they think, oh, that's way too complicated.
It sounds intimidating, but Graham actually lays out a pretty straightforward approach.
Okay, so it's not just for, like, Wall Street experts.
No, not at all.
No.
It's for anyone who's willing to put in the time. It's about looking beyond those fluctuating market prices and understanding, like, the actual performance of the company, their financial health.
So it's like buying a house. You don't just look at the curb appeal.
Exactly. You want to see the foundation, the structure, the plumbing. You're looking for those hidden problems.
You're kicking the tires.
Kicking the tires, exactly. And the starting point, it's those financial statements.
Ah, those can be scary.
They can seem scary, but Graham breaks them down. He explains the balance sheet, the income statement, cash flow statement. Each one gives you clues
Clues about the company's health.
about their stability, their profitability, financial strength.
So it's about learning to read the language of business?
Exactly. Understand what those reports are telling you.
Okay, that makes sense. But it's not just about the numbers, right?
No, you got to look beyond the numbers.
What else should we be looking at?
You got to look at the management. Even with great numbers, a company with poor leadership, it can go downhill fast.
It's like having a talented sports team, but a bad coach.
Exactly. The coach can make or break the team, and the same goes for company management.
So you look at their track record, their integrity,
Absolutely. Are they ethical? Do they deliver on their promises?
and they actually lead.
Exactly. Can they lead the company to success?
And you also need to consider, the long-term prospects of the company.
Oh, absolutely. What are the industry trends? Do they have a competitive advantage? What's their potential?
Well, you're not just looking at the present, but also envisioning the future.
Exactly. What's their potential for future growth?
Okay, so we've talked about a lot of different factors here. But this brings us back to one of Graham's, I think, most famous concepts, and that is the margin of safety.
Ah, the margin of safety.
Explain that one to me.
It's that difference between the intrinsic value of a security, what we were talking about earlier, and its market price.
Okay.
Think of it as buying something on sale.
Yeah.
You're getting a good deal even if things don't go perfectly according to plan.
So you're building in that cushion to protect yourself?
Exactly. You're building in that cushion, protection from unexpected twists and turns. And this applies to any investment. Stocks, real estate, even a private business.
So it's a universal principle for intelligent investing.
It really is.
Okay, good to know. Now, you've mentioned this before, earnings per share, EPS. What does that actually tell us about a company?
EPS. It's essentially how much profit a company makes for each share of stock. Higher is generally better, but Graham warns us, don't just look at the number itself.
Oh, there's more to it than meets the eye.
There's a lot of factors that can influence that number, and some of them might not reflect the company's true earning power. You got to dig deeper.
Ah, so you got to look at the story behind the number.
Exactly, the story behind the numbers. Equally important is the quality of those earnings. Are they sustainable, backed by real cash flow, or are they based on some accounting trick?
Okay, right. So real profits, not just smoke and mirrors.
Real profits, that's what we're looking for. And we also need to look at the growth in earnings.
Okay, so is it consistent? Is it sustainable?
Is it consistently increasing? Can they keep it up?
We're looking for that solid foundation for future growth.
Exactly. And this ties into another metric that's often used. The price-to-earnings ratio, or PE ratio.
Okay, PE ratio. I've heard that one tossed around a lot.
It compares a company's share price to its earnings per share.
Yeah.
Gives you a sense of how the market's valuing a company.
So high PE, good. Low PE, bad.
Not necessarily. Graham says don't make those simplistic judgments. A low PE could mean it's undervalued, or maybe there are concerns. High PE, maybe justified optimism, maybe a bubble.
So again, it's all about the context.
Context is key. To illustrate this, Graham actually walks us through 4 real-life company case studies.
Oh, okay, like real-world examples.
He shows us how these principles can be applied to make real decisions.
So we can see the theory in action.
Exactly. See how it plays out. And the first thing he really highlights is the financial health of a company. He scrutinizes those debt levels, liquidity, how well they manage their assets.
So it's like checking their vital signs.
Exactly, making sure they're in good shape. And as we discussed before, that consistent track record of earnings is vital. He examines each company's earnings history.
Okay, so can they consistently generate profits?
Can they deliver? Are they reliable? And don't forget the dividend record. Consistent dividend payments are a big plus.
Because that shows they're sharing the wealth with their shareholders.
Exactly. They're sharing the wealth. They're confident in their future earnings.
It's like getting a regular paycheck from your investments.
It is like getting a paycheck, steady income.
Yeah.
And of course, we have to consider those growth prospects, right?
The future potential.
Are they in a growing industry? Do they have a competitive advantage? What's their potential for expansion?
So we're looking at the past, but we're also trying to envision the future.
Absolutely. You got to have that long-term vision. And finally, Graham assesses whether each company's stock is priced attractively. Is there that margin of safety?
Ah, so he's looking for those deals, those bargains.
He's always looking for those bargains, those companies worth more than the market is giving them credit for.
Okay, so now let's focus on the defensive investor again. What kind of stocks should they be seeking out specifically?
For the defensive investor, Graham recommends focusing on those large, prominent, financially sound companies. Think blue chip, stable histories, consistent earnings,
So like the giants of the market.
the giants, the ones that can withstand those economic storms.
Okay, and he gives us a checklist, right, for evaluating these potential picks.
He does, he does. First, consider size and stability. Are they large enough to withstand those downturns?
So can they weather the storm?
Can they weather the storm? Then assess their financial condition, healthy balance sheet, manageable debt, strong assets.
So they're built on solid ground.
Solid ground, absolutely. And again, we look at earnings stability. Are those earnings consistent over the years?
Okay, so we're looking for consistency, reliability.
Consistency and reliability, those are the key words. And don't overlook that dividend record, history of consistent payments.
Okay, that's a good sign.
It's a good sign, shows their commitment to their shareholders.
Okay.
And finally, pay attention to that PE ratio. Make sure you're not overpaying for the stock compared to their historical averages or the market average.
Okay, so look for those undervalued opportunities, those companies with a bright future that maybe the market hasn't fully recognized yet.
Exactly, you're looking for those hidden gems. Now, let's turn our attention back to the enterprising investor, the ones willing to put in a little more effort, maybe take a little more risk,
Okay, so they're more hands-on, right?
much more hands-on. And one of their strategies might be searching for those undervalued stocks.
Okay, how do they do that?
They're like detectives, digging into the financials, analyzing industry trends, trying to spot companies the market is mispriced.
So they're looking for those clues, the things that maybe other investors have overlooked.
Precisely, they're looking for those hidden signs.
Mhm.
They might also explore special situations, remember those?
Right, right. Mergers, acquisitions.
Mergers, acquisitions, spin-offs, reorganizations, those can create opportunities, but they require careful analysis.
It's like you got to be able to read the tea
You
leaves.
got to read the tea leaves, and timing is everything.
Okay, now I got to ask. Traditionally, Graham's considered more conservative, right?
He is.
But he acknowledges that some enterprising investors might go for those high-growth stocks.
He does. But he emphasizes investing in those growth stocks, you have to really assess the sustainability of that growth.
So is it hype or is it real?
Exactly. Is it built on a solid foundation or just hot air?
You got to know the difference.
Absolutely. Another strategy they might consider, investing in turnaround or distressed companies.
So companies that have maybe stumbled, but they have the potential to make a comeback.
Exactly. Fall on hard times, but maybe there's a chance for recovery.
It's like a high-risk, high-reward kind of situation.
It is. Requires a deep understanding of the business.
What went wrong? Can they fix it?
Exactly. Can they fix it? And unlike the defensive investor, the enterprising investor is actively managing their portfolio, always looking for ways to adjust.
So they're constantly in motion.
Always in motion, responding to the market.
Now, I think we need to dive into a topic that can be a little complex.
Okay, what's that?
Convertible issues and warrants.
Ah, yes, these can be a bit tricky.
They are. Break it down for us.
Okay, so convertible securities, they're like bonds or preferred stocks.
Mm-hmm.
They can be converted into common stock of the issuing company.
So it's kind of like a hybrid.
It's like a hybrid investment, a bit of a bond, a bit of a stock.
Mm-hmm.
And warrants, they give you the right, but not the obligation, to buy a company's stock at a set price before a certain date.
So it's like an option to buy later.
Exactly, like an option. If the price goes up, you can profit. If not, you don't have to buy.
Okay, so you get the potential upside, but with some of the safety of a bond. Sounds like having your cake and eating it too.
Well, it's not quite that simple. Graham stresses that these have their own risks.
Okay, what are the potential pitfalls? What should people be aware of?
First, you really got to scrutinize those conversion terms. The price, the time frame, make sure they're favorable.
So read the fine print.
Always read the fine print. And then there's the performance of the underlying stock. If the price doesn't go up, that conversion feature is worthless.
So you're still exposed to the market.
You're still exposed to the market, absolutely. And be careful about overpaying for that conversion feature. Sometimes the market gets a little carried away, inflates the price.
So you got to be realistic, not get caught up in the hype.
Exactly. Be realistic, do your research. And as with any investment, consider how it fits into your overall strategy.
It's got to align with your goals.
Absolutely, your goals and your risk tolerance.
Now, I love case studies, and Graham gives us some really interesting ones in Chapter 17.
He does. 4 real-life case studies showing these decisions playing out.
So it's like we're watching a financial drama unfold.
Exactly. You see the consequences of different approaches. And one recurring theme he highlights is the danger of speculation.
Right, because speculation can be tempting, but it's risky.
It is risky. He shows how those who chase hot stocks without understanding the value, they can suffer.
So it's a reminder that hype is not a substitute for good analysis.
Absolutely. And these case studies really highlight the importance of fundamental analysis. Graham demonstrates how you can avoid losses or make gains by carefully evaluating.
So do your research, don't rely on rumors or gut feelings.
Exactly. Do your homework. And he also delves into that psychology of investing, fear and greed.
Oh, yeah, our emotions can really mess things up.
They can cloud our judgment, make us act irrationally. The case studies show the benefits of staying rational, detaching yourself from the market's mood swings.
So be a stoic investor. Don't get caught up in the hysteria.
Exactly. Stay calm and focus on the fundamentals. And of course, he emphasizes that margin of safety.
Right, right.
These case studies show how buying below that intrinsic value can protect you.
So it's like having that financial airbag to cushion the blow.
Exactly. It's your cushion. And those case studies really drive home the importance of a long-term perspective. Patience in fundamentals can lead to superior returns. Chasing those short-term gains often leads to disappointment.
So be a marathon runner, not a sprinter.
Love that analogy.
Focus on the long game. Don't get distracted by the short-term fluctuations.
That's the key. Now get ready for Chapter 18 because Graham does something really interesting here. He compares 8 pairs of companies from the same industry.
Oh, that's cool. So like head-to-head competition.
Exactly. Head-to-head. See how even subtle differences in management or strategy can impact outcomes for investors.
So we can see what really makes a difference.
What makes a difference? And those comparisons, they reveal some really interesting insights. The first one that really stands out is the importance of management quality.
Oh, okay.
Companies with leaders who are, competent, honest, shareholder-friendly, they tend to do better.
That makes sense. It's not just about the business itself. It's about the people running it.
Exactly. And these comparisons also highlight the importance of financial discipline. Those companies that manage their debt wisely, they maintain strong balance sheets.
So being prudent, not taking unnecessary risks.
Exactly. Being prudent, avoiding those reckless moves, those tend to be the ones that can navigate the challenges more successfully.
Okay, so financial health matters.
Absolutely. Graham also looks at different growth strategies, showing that, not all growth is created equal.
Oh, that's interesting.
The sustainable, profitable growth, funded through internal cash flow, that's the gold standard, not just rapid expansion fueled by debt.
So it's about growing smart, not just growing fast.
Exactly, growing smart. And those comparisons also show how sometimes the market's perceptions can be totally off. They can misprice companies based on emotions or short-term trends, creating opportunities for those savvy investors.
So the market can be wrong, and those who can spot those mistakes can actually profit from them.
That's the key. Being able to recognize those discrepancies, buy when it's undervalued, sell when it's overvalued.
It's about going against the herd, being a contrarian.
Being a contrarian, that's a good way to put it. Always questioning those prevailing assumptions.
Okay.
And finally, those comparisons reinforce the importance of valuation. The price you pay really does matter.
Right.
Buying undervalued stocks, fundamentally strong companies, that's the path to long-term success.
So it's about finding that sweet spot, that balance between quality and value.
Got it. Now let's shift gears and talk about a topic that a lot of investors love, dividends.
Dividends. Everybody loves getting those
Is
payments.
there like a little bonus for being a shareholder?
They are. So, Graham, how does he view dividends?
He sees them as more than just income.
Okay.
They're a signal of a company's health and a sign that management, they're committed to those shareholders.
So it's a way for companies to share their profits with the people who own them.
Exactly. Sharing the profits, rewarding those who have invested in the company. But Graham also warns against just chasing those high dividend yields without looking at the bigger picture.
Okay, so a high dividend yield isn't always a good thing.
Not necessarily. Sometimes a company might offer a really high dividend to attract investors even if their business is struggling.
So it's like a red flag.
It can be a red flag.
Yeah.
It's like putting lipstick on a pig, trying to make something look better than it actually is.
So you gotta look beyond the surface. Don't be fooled by those flashy numbers.
Exactly. You want to analyze those earnings, the debt levels, the overall stability.
Okay, make sure those dividends are sustainable.
Sustainable, that's the key word. Coming from real profits, not just financial trickery.
Okay, so we've covered a lot of ground here. But I think it's time to revisit one of Graham's most important principles, the one we've been talking about throughout this deep dive, and that is the margin of safety.
The margin of safety, it's like the bedrock of his entire investment philosophy.
It is. It's so crucial. Remind us again, why is it so important?
Because it's your shield against the unknowns, against those unpredictable market forces. No matter how good we are at analyzing, we can't predict everything.
The future is uncertain. Things happen.
Exactly. We have to acknowledge that we're human, we make mistakes. The margin of safety helps us account for those mistakes.
So it's like having a safety net.
It's like having a safety net, a buffer against those unforeseen events. And it's not just about avoiding losses. It's about being a disciplined investor.
Okay, how so?
It encourages you to be patient, to wait for those opportunities where the price is so attractive, so far below what you think it's worth, that you're almost guaranteed to come out ahead.
So it's about buying things on sale.
Exactly. Buying on sale, getting a bargain. And that disciplined approach, it helps you avoid getting caught up in those emotional swings of the market.
Right. Don't let Mr. Market trick you.
Don't let him trick you into making a bad decision. The margin of safety gives you the power to say no to those bad deals and wait for the good ones.
So you're in control, not the market.
You're in control. And that leads us to another important point that Graham makes, and that is the distinction between being an investor and being a speculator.
Okay, we talked about this a bit at the beginning, but why is this difference so important?
Because the investor is focused on the long term. They're looking at the underlying value of their investments. They're buying with that margin of safety.
They're in it for the long haul.
Exactly. They're like the marathon runner, patiently making progress toward their goals. The speculator, on the other hand, they're more like the sprinter.
Oh, okay.
They're trying to make a quick buck, chasing those hot stocks, betting on those short-term price movements.
So they're more impulsive, driven by those quick wins?
Exactly. Driven by emotion, fear, greed. The investor, they're striving to make those rational decisions based on research and analysis.
So the investor's playing the long game, the speculator's gambling.
Exactly. And Graham, he makes it clear, speculation, it might be tempting, but it's a dangerous game.
It's risky. You could lose everything.
You could lose everything. It's like playing roulette. You might get lucky a few times, but the odds are stacked against you.
So stick to the fundamentals. Do your research, invest with a margin of safety. Don't get seduced by those quick riches.
That's excellent advice. Now, as we start to wrap up this deep dive into the intelligent investor, I think it's helpful to just take a step back and think about some of the key takeaways.
Yeah, distill those nuggets of wisdom for us. What are the most important things our listeners should remember?
Well, first and foremost, remember that investing is a process. It's about building wealth over time. It's not about getting rich quickly.
It's a marathon, not a sprint. We've heard that one before.
Exactly. It's a marathon. You have to be patient, stay disciplined, and focus on the long term. And don't forget about diversification.
Right. Spread that risk.
Spread your investments across different asset classes, different industries, different regions. It's a fundamental principle for managing risk.
Okay, so build that diversified portfolio.
Exactly. And when it comes to choosing those specific investments, focus on those high-quality companies, strong fundamentals, good track record. They treat their shareholders well.
Look for companies that are built to last.
Exactly. Built to last. And as we've been saying throughout this whole deep dive, never forget the importance of that margin of safety.
Right. Buy those assets for less than they're worth.
Less than they're worth, you're building in that cushion, protecting yourself from those unexpected events.
And remember, stay disciplined. Don't let your emotions get the best of you.
Discipline is key. Stick to your plan. Avoid those impulsive decisions. Remember, building wealth, it's a journey, not a destination. It takes time.
So stay calm, stay focused, and let the power of compounding work its magic.
That's it. Let time work for you. Now, I know we've covered a lot in this deep dive, but we've only scratched the surface of The Intelligent Investor.
It's a dense book, packed with insights.
It is. It is. I encourage everyone listening to get a copy, dive deeper, really explore Graham's ideas. It's an investment in your financial education that will pay dividends for years to come.
Absolutely. And even experienced investors can benefit from revisiting these principles.
Absolutely. The market's always changing, but the fundamentals of investing, those remain the same.
Those are timeless.
Timeless. Now, before we move on to the last part, I just want to remind everyone, investing is personal.
It is.
What works for one person might not work for another.
Right. Everyone has their own goals, their own situation.
Exactly. Find an approach that aligns with your goals, your risk tolerance, your financial situation.
It's like finding the right size shoe. It has to fit you.
Exactly, the right fit. And as you go on this journey, remember, knowledge is power.
Keep learning, keep growing.
Keep learning, stay curious, and never stop striving to become a more intelligent investor.
Well said. All right, in the final part of our deep dive, we're going to explore some additional insights from Graham and answer some of those burning questions about the intelligent investor.
All right, so we're at the final chapter of The Intelligent Investor. And Graham really brings everything together here. He leaves us with this powerful reminder of what he thinks is the most important principle of all.
Okay, I'm ready for this. After this whole deep dive, what's the big takeaway, the most important thing?
He comes back to the cornerstone of his whole philosophy, and that's the margin of safety.
Right, right. We've talked about that quite a bit, but it's clearly super important to him. So one last time, why is that margin of safety so crucial?
Because it protects you. It protects you from all those things you can't predict in the market, and even from your own mistakes.
Right, because no matter how much research we do, the future's always going to be a bit of a mystery.
Exactly. It is. Things happen, markets change, and sometimes, we just get things wrong.
We're human. We're not perfect.
We're not perfect, and that's where the margin of safety comes in. It's like a buffer, a cushion that helps you absorb those shocks.
So it's like a financial safety net.
It is. It's like an insurance policy for your investments. And remember, it's not just about avoiding losses. It's about being a disciplined investor.
Okay, so how does it encourage discipline?
It forces you to be patient, to wait for those really great deals where the price is so low, so far below what you think it's worth, that you're basically guaranteed to come out ahead in the long run.
So it's about being selective, waiting for those real bargains.
Exactly. And that kind of patience helps you stay calm when the market's going crazy. Mr. Market might be freaking out, but you can just sit back and say, nope, not falling for that.
You're not letting him manipulate you.
Exactly. You're in control. Now, as we wrap up this deep dive, I want to emphasize that Graham's wisdom, it's not just for stock picking.
Okay, it applies to other areas of investing.
It applies to everything: real estate, bonds, even starting your own business. Those same principles of value, patience, and that margin of safety, they can help you in any financial decision.
So it's really about developing that intelligent investor mindset.
Exactly. And remember, The Intelligent Investor, it's not just a book you read once.
Right.
It's something you keep coming back to. You reread it, you think about it, you apply it to your own situations.
It's like a guidebook for your investment journey.
It is. It's a guidebook. And I think even the most experienced investors can benefit from revisiting those principles, reminding themselves of the basics.
Absolutely.
Because those fundamentals, they never go out of style. Now, before we say goodbye, let's just recap those key takeaways, the things you could start applying today.
Okay, give us those golden nuggets of wisdom one last time.
First, remember, investing, it's about building wealth slowly and steadily. There's no get-rich-quick scheme, no magic formula.
It's about putting in the work, doing the research, and being patient.
Exactly, and diversifying your portfolio. Spread that risk across different assets, industries, geographies. Don't put all your eggs in one basket.
Right. We want a balanced portfolio able to weather any storm.
Exactly. That's the goal. And when you're choosing those individual investments, look for quality. Look for companies that have strong financials, a good track record, and treat their shareholders well.
Look for the companies that are built to last.
Built to last. That's it. And of course, never forget that margin of safety. Buy at a discount, protect yourself.
Always be a bargain hunter.
Always be a bargain hunter. And finally, the most important thing, stay disciplined. Don't let those emotions control your decisions.
Right. Don't panic when the market drops. Don't get greedy when it's soaring. Stick to your plan.
Stick to your plan. Remember, building wealth is a marathon, not a sprint.
Well, that was an amazing deep dive. Thank you so much for taking us through The Intelligent Investor. I feel like I've learned so much, and I'm ready to go out there and start applying these principles.
I'm glad to hear that. Remember, investing is a journey. And the more you learn, the better equipped you'll be to navigate that journey successfully.
Absolutely. We hope you enjoyed this deep dive as much as we did, and we encourage you to continue exploring the world of investing. Remember, the best investment you can make is in yourself.
That's right. Keep learning, keep growing, and until next time, happy investing.